Hi, welcome to recording number 6. In the last one, we looked at non-exec directors and what they were about. We also looked at chairman and the CEO. This recording, we're going to actually look at the non-exec directors and what they get up to, because what you hope to have in the corporate governance are 4 committees. The audit committee, which basically liaises with the external auditor. It's also group of people who look at the financial statements and they liaise with the internal audit team and controls on risks of the business. That's who the audit committee are reporting into. Remuneration committee, they set and advise on the directors' remuneration, the executive directors. The risk committee, often in businesses, is part of the audit committee, but hopefully it's perceived that under good corporate governance it should be separate. What they're looking at is embedding the risk awareness in the company. You would have a risk manager in charge of it who would report to the risk committee. As I say here, it's possibly in smaller entities part of the audit committee. Finally, the nominations committee is the group of people who appoint the executive directors and make recommendations. Now, the key thing to note is who is on what committee. Non-executive directors exist entirely on audit committees, and remuneration committees are made up entirely of non-executive directors. However, risk committee and nominations committee, it's mostly non-executive directors. So it's a majority, but it's not 100%. Okay, that's a key thing to note. Same with this risk committee. Okay, the reason being that for an audit committee, you're reporting on the results, and therefore executive directors probably are getting remunerated accordingly. So therefore you get complete independence. The remuneration committee, well, clearly you can't have executive directors involved in their remuneration, so therefore it has to be all non-executive directors. The other two, risk committee and nominations committee, it's beneficial to have executive directors on there too, because they have their experience and knowledge and want to hear what non-executive directors are thinking, and good and bad, straight away. So, role of a non-executive director in more detail. It's again an important issue, frequently appears. I think it is being updated even as we speak, because there isn't a feeling that they are sometimes rather symbolic in their nature and not contributing enough. And with the economic crisis, they really have become under a bit more scrutiny as to what were they doing when the walls were falling, when the buildings were burning. So I think this is an area that's been looked at and hopefully will be improved and given a bit more teeth. Just to be clear, what a non-executive director is, they have no executive, i.e. day-to-day management responsibilities. If they did, they would lose their independence. So they shouldn't have any specific portfolio responsibilities. It gives them therefore freedom to criticise when things don't go well, but also before things go good, they can just suggest that's good or whatever. There are checks and balances in the system. They have a key role in reducing conflicts of interest between management and shareholders. So they're trying to strike a balance between the two. As we said way back in earlier recordings, sometimes management don't have the same agenda as shareholders, and therefore you end up with problems. Key thing to note, however, is that non-executive directors, they do share the same legal duties and potential liabilities as full executive directors. So if something goes wrong with the company, i.e. administration or insolvency, wrongful trading, etc., they are equally liable. So they don't have responsibility for it, but they do have liability. So it's not to be taken lightly when accepting one of these roles. Because they're not full-time employees, they do bring an independent viewpoint, which is what you're basically bringing these non-executive directors in and all these different committees. 4 principal roles of responsibility: people, internal control and risk awareness, strategy and scrutiny. So they're responsible perhaps for selection, remuneration and assessment of directors. They will lead the company's efforts to ensure that data about risks is properly obtained, collated and assessed. They should contribute to strategy, not necessarily lead it, but contribute towards it. But they should have their own experience they're bringing on board from their perhaps previous roles as executive directors in other organisations. Their external experience is meant to be useful. They will scrutinise the performance of management in meeting goals and objectives and monitor it. So it's not just, okay, off you go. It should be after the event and come back and have a look. Now, boards can be in 2 forms. They can be a unitary or they could be multi-tiered. Unitary board is one where all the directors, both executive and non-executive, participate in the same board meeting. A multi-tier board has a separate supervisory board. So people are not always on the same board. There's like the lower one and the supervisory above it. Now in exams, the key thing here is to note that the advantages of one are effectively the disadvantages of the other. And when you're doing exams, you mustn't just come down on one side with your opinion. You must give both sides. So it's a nice list to try and learn. It will help you in your exams. So all participants have equal legal responsibility for management of the company. A single board promotes easier cooperation and coordination, i.e. dialogue and communication is that much easier. The presence of NEDs should lead to better decisions being made. Their input will be valuable. Independent NEDs are less likely to be excluded from decision making and given restricted access to information. In other words, a bit of a clique is less likely to form. Having said that, you've got drawbacks of a unitary board structure, which is the same as the advantages of a unitary structure. So whichever way you look at it, you've got these to think about. An NED or independent director cannot be expected to both manage and monitor. The time requirements on non-executive directors may be onerous, meaning that only weaker quality non-executive directors are willing to accept the role. Good ones will probably be non-executive directors of many organisations. There is no specific provision for employees to be represented on the management board, where when you have multi-tier boards, quite often you allow banks to be on board, you allow employees to be on board because there are more than one tier of boards. And finally, there is an emphasis of the division between the shareholders and the directors, as the supervisory board is another layer between management and the shareholders. So it creates a bigger gap in knowledge and seen as a disadvantage of a unitary board. Okay, so that's the end of that recording. I'll see you in the next one.